Hello, all you beautiful people. Yes, it's a great day. Why? Because we're alive. Anyways, I'm the late fire starter, and late because I started when I was older, and FIRE stands for financial independence and retire early. So I started late, and I'm on my way to financial independence using dividend income and rental income. Living cheaper is my specialty. You can check out my other channel called The Cheap Guy. That's me, The Cheap Guy. Yes, that really helps with financial independence because if you get your costs low, then you need less to live. This is going to be a multi-year journey to get to financial independence, and I would love to have you along. I'd love to answer any questions you have. I'd love for you to be inspired by what I'm doing. So go ahead and hit subscribe and join this community that's joining financial independence and freedom. Go ahead and hit that like button because everybody loves likes. If it was a love button, that would be even better. But that gets a little weird, right? A little confusing sometimes, especially, imagine if all the like buttons were love buttons. Now they have the hearts, and those are kind of taken over, so maybe that was a good idea. I should really market these things. Anyways, today we're going to talk about options, stock options, specifically covered calls. So I'm going to explain what covered calls are. I'm going to explain why covered calls are such a buzzword in the dividend community. And I'm going to tell you my story of options past and present. I wanted to start out telling you just my personal story. Years and years and years and years ago, I was buying options. You can buy options or you can sell options. An option is basically a contract. What you are saying is I'm buying the option to buy 100 shares of a stock. If I buy an option, if I purchase this contract, each contract is for 100 shares. That never changes. So I buy a contract for 100 shares. This contract may cost $1. A dollar contract would cost me $100 because I'm paying $1 per share. Now, what am I buying and why am I buying it? I'm buying this because I think the stock's going to go up. If I buy a particular stock, let's say I buy Apple, and let's say Apple right now is at 115, and I think it's going to go to 150 in the next 3 months. I can buy an option for Apple at 125 in 3 months, say for $1. So I pay $100 for that right. If it goes up to 150, I can now buy 100 shares at 125. Does that make sense? I'm betting the stock goes up. If it goes up more than what I paid, I win. So if it goes up more than $1 per share, I win. If it doesn't go up enough, I just lose all my money. I can also sell my stock option. So if I buy an option to buy 100 shares of Apple in 3 months from now at 150, and let's say in 2 weeks it goes up to 140, now what I bought for $1 per share is now worth, say, $3 per share. So now I can take that option, that contract that I bought, and I can sell it. And I paid $100 to buy it, and now I'm selling it for $300. So I just made $200 for nothing, really. However, if at the end of those 3 months, Apple's not at 150, if it's at 140 or 120 or 90, that $100 that I spent for that contract is worth nothing. It goes to zero. So that is the risk. Higher risk, higher reward. That's normally how it works in investing. When I first got into options years and years ago, I was buying options. I was buying the contracts. My biggest winner ever was I bought a contract for Google before they were reporting earnings. This was about 17 years ago. I think this was in 2002 or 2003. I spent $1,000 on contracts for Google. I don't remember the details. I don't remember if I bought 1 or 2 or 3. I don't remember what I bought, but I do know I spent $1,000. After the market closed, Google announced their earnings and they beat earnings. I went to bed. I woke up the next morning and I sold my option, my stock option, my contract for Google. I sold it less than 24 hours. Literally like 12 hours later, I sold that contract for $13,000. Why was it worth so much? Because 100 shares of Google at the price that this contract allowed you to buy was already cheaper than what it was at. In other words, if you were going to buy 100 shares of Google and it was at $250 and now you could buy 100 shares at $200, you just saved 100 times, you just saved $5,000. At this point, it was way above. So my contracts were worth a lot of money. So I spent $1,000, went to bed, and sold it for $13,000. So I made $12,000 overnight. My biggest win ever to this day. Unfortunately, I took those winnings, those earnings, and I say winnings because it really is kind of like gambling, that money I made off Google options, and I purchased other options, and those failed and went to zero, and I lost all the money. That's also like gambling, and I was treating options like gambling at the time. Eventually, I swore off all options. I said, this is too risky. I don't like losing money. So I swore off all options, and I just didn't touch them for decades. Then I started dividend investing, and I started really looking at income-paying funds. One fund that is very popular within the income dividend, what I mean by income is some people want to invest in stocks for growth. So if you're investing in Tesla or Apple, what you're hoping is your money grows. With income, what you're hoping is to get a steady dividend. You're hoping for cash flow. You want to pay your bills. You want to pay your rent. You want to use that money for ice cream, whatever it may be. And you don't really care if it goes up in value, if the stock goes up in value or not. As long as the stock just continues to pay you money, you're fine with that. So as long as you never plan on selling, income funds, income dividends funds, income stocks are fine. And a really popular one that's got a very high yield, what that means is just they pay a very large dividend. It's like 11%. So for every $100 of this fund, you get $11 a year for every $100. It's really great. And so this particular income fund I'm talking about is QYLD, very popular. I own a lot of it. There are other income funds that use the same strategy. And the strategy QYLD uses is called covered calls. I mentioned before that I was buying options. When I was buying options for the stock to go up, I was buying calls. Calls are basically saying, I am calling out this price. I am calling the right to buy this stock at a higher price at a certain date. And if the stock goes past that price, you win. And if the stock goes up to that price or down, you lose. So a call is betting on the stock going up. The opposite is a put. I'm putting down this stock. This stock sucks. I'm putting it down. And so I'm calling out this stock's a winner. I'm putting down this stock. So a put is saying the stock is going to go negative. So if the stock goes down, you win. If the stock stays the same or goes up, you lose. So that's the difference between a call and a put. A covered call, however, is a call not that someone buys, but that someone sells. When I was buying Google options, somebody had to sell me those options. And what they were selling me was the right to buy their shares of Google. A covered call means that they had the shares to sell me. If it's not covered, if it's a naked call, it means they don't have the shares. And if they have to cash in and sell me those shares, they have to buy the shares at the time of the expiration of the contract. Covered calls, however, says I have the shares and I'm willing to sell them to you at this price, at this date, if it so happens. QYLD and other income funds, what they do is they hold stocks. QYLD specifically holds NASDAQ stocks, but they hold these stocks. They own the stocks. They own shares in the stocks, and they sell, they don't buy, they sell options to other people, and they're called covered calls because they have the shares to sell, the right to buy. Every time you sell a covered call, you get cash money. So when I bought that Google call back years and years ago and I spent $1,000, whoever I bought that call from got $1,000 from me. And that money was cash. They could just take that money and go buy ice cream. Lots and lots of ice cream. So when you sell covered calls, you immediately get money. What QYLD does is they take their stocks and they don't just make money off the stocks, but they're selling covered calls on their stocks, making an extra $100, $50, $1,000 here and there. They take all that money and they pay it out to us or to whoever holds their stock in dividends. When you hear the word covered call, or when you hear of a fund having a covered call strategy, all that means is they are generating income by selling calls on the shares of stock that they own. I got back into options about a year ago with this particular strategy. I did not want to buy calls anymore. I wanted to sell them. I wanted to sell the rights to buy my shares. In particular, with this down market and flat market, I've been making money off my stocks that have been losing. For example, American Airlines. I bought American Airlines at $12.23. And as American Airlines goes up to 13 and down to 12 and up to 13 and down to 12, I can continually sell covered calls of my shares of American Airlines and make money. So I would sell 2 contracts because I have 200 shares. I would sell 2 contracts for the next month and make $60 here. Sell 2 contracts when that expired the next month, make $100 here. Sell 2 contracts, make $50 there. All in all, doing covered calls just on American Airlines, I have made over $700 in the last few months. When you think of 200 shares of American Airlines, well, if I bought it at $12.23, so I've bought $2,466 of American Airlines, and I still have the shares. But on those shares, by selling covered calls, I have made an additional $700. If you divide that number, that 700 number, by 200 shares, all of a sudden you see I have earned over $3 per share. So instead of my average share price being $12.23, now it's all of a sudden $9 and change. If the stock goes down to $10, I'm still ahead in the overall game. I've been making money off my covered calls with American Airlines because the stock market's been mostly flat. Even when it's gone up, it hasn't gone up too high and then it's come down. Until recently. The last few days have exploded. American Airlines went from $12.50 up to $15 in 2 days. I had covered calls on all 200 of my shares that were expiring on Friday, which means on Friday I had to sell all 200 shares of my American Airlines for $13.50. That's still higher than I paid for them, but at the time, if American Airlines on Friday was selling for $15.50, I would be losing $2 per share or $400 of potential gain. Not actual gain, but potential, because I haven't sold the shares. American Airlines is up and it's gonna stay up at this point, most likely with the vaccine news coming out and other things happening. I had sold my last covered call option price at $1 per contract. Sold 2 contracts, so I made $200. I figured overnight there would be a sell-off of American Airlines and other stocks for that matter. Because the way the market's been going, it goes up for a day or 2 max and then people start selling. So I put in an order to buy back my covered calls. I sold covered calls. So I opened a contract, and now what I was doing was I was buying to close that contract because I didn't want to sell my shares of American Airlines at a potential loss. So what I did was I put in a limit order saying if it hits this price, I want to buy to close. I want to buy back my contract. So what I did was I put in 91 cents. In other words, I was going to wipe out most of my gains from my last covered call, but I still wanted to ensure I made a little money. In this case, it was $7.33. Sure enough, that order was fulfilled. What had happened was early morning trading days, American Airlines dipped low enough that the contract sold for 91 cents and then immediately went back up. In that little teeny window, I was able to buy back my contract at a slightly less price than what I sold it at to keep my shares, but only because I had a limit order that executed while I was sleeping. I got lucky in a sense, but I also kind of guessed this would happen. So as you can see, covered calls on American Airlines have made me money. Also, you could see that if I sold them for $13.50 a share, I would still be making money on the shares. The reason I spent the money to buy the contracts back is because American Airlines is now $15, and I don't want to sell my shares at $13.50 when they're $15. The stock could come back down again. The stock could go way up. I don't really know. But at this point, the American Airlines shares are mine, and no one has a contract to buy them from me at any price. I will continue to sell covered calls on American Airlines and take that gamble, but once in a while the stock market shoots up so fast, so quick, that all of a sudden those covered calls that seemed very safe get wiped out. Like anything, there's risk involved, and like anything, there's strategy involved. But I just wanted to share with you both my covered call strategy as well as my history with options, and maybe help you learn a little bit about what people mean when they talk about covered calls, especially when it comes to dividend funds that use a strategy of covered calls to get income. Thanks for watching. Thanks for taking the time to be with me on my journey. Once again, if you haven't yet, subscribe and like. And down below, I'm going to have links to my other channel, The Cheap Guy, which is all about saving money. So if you want tips or tricks to save money. Also, if you have any great tips on covered call funds that you like, or if you have more questions, or if this made you more confused, let me know down below and I can get better better at teaching because I love teaching, but I'm used to having a whiteboard, so maybe I should get a whiteboard. What do you think? Should I get a whiteboard? Anyways, let me know down below. Have a great day.